Hello and welcome. My name is Benoit Podiquet. I'm the founder and one of the portfolio managers here at Exponent Investment Management. And you're watching the third quarter 2024 review. So let's get started with our usual performance table. What you'll see is Canada was actually one of the best performing markets for the quarter, up 10.5%, compared to 4.7% in Canadian dollar terms for the S&P 500. So that includes, when we say total return, it means appreciation and dividends. And NASDAQ had like a flattish quarter with 1.4. You can see on the one-year numbers still very, very good, except for our Canadian dollar. Bonds have a decent put in a 12-month performance that's very good, with interest rates falling, bond prices increasing, but we're still flat on a 3-year basis. And pretty much all asset classes now are presenting basically at double-digit returns. And so it's interesting, the 2022 performance, negative performance, the S&P 500 and the NASDAQ is kind of a vague or faint, distant memory for some. Interest rate wise, we're looking at 5-year GICs. We are moved away from the 5% just a few quarters ago, down to around 4%. Still getting close to 4.5% on a 5-year GIC. Government of Canada bonds. If you lend our government money for 5 years, you're going to get 3.5%. For 10 years, slightly less at 3.49, and the 1-year rates are still higher than the 5-year rates. Gold prices had a really good quarter. They're having gold prices are having a good year. Oil prices not so much. We remember when this was $120 barrels. Canadian currency, not a whole lot going on. So if we summarize, Canada had a great quarter. U.S. markets kind of broadened out, so technology took less of the front and center piece, if you will. And you might have noticed in your portfolios, most of the stocks are up now. So that's actually, we're going to talk about that a little bit, but that's a healthy sign. Technology slowing down, interest rates are falling. We're going to talk about inflation in the next few slides, but inflation certainly expectations, and certainly our expectations, the data that we're seeing and is pointing to a lower inflation. The patient investor, so that is, the people we speak to and we work for. What is your benchmark? Clearly, these 3-year numbers are ahead of what a patient investor typically would expect. We're now starting to have some conversations with some investors, some clients, and many prospects where sort of the memory of losing money is kind of gone by the wayside. It's the idea of consistent performance, low volatility, higher income is really given way to having conversations around maximizing performance. So the 22 memories of minus 18.1% on the S&P 500, minus 33% in calendar 2022 for the NASDAQ, they seem to be sort of been erased from many investors' minds. And for us, that's always an issue because that tends to make some people take on extra risk probably at the wrong time. If we look at the headlines that dominated the news, obviously the first half of the year belongs to artificial intelligence and AI. Now, AI means a lot of things to a lot of different people, and it's probably one of the most overused buzzwords of 2024. But if we look at ChatGPT, which is one of the platforms that uses artificial intelligence. If you haven't used it yet, I strongly encourage all of you to use it because, in fact, this video was partly used with ChatGPT. Especially, it's a great translation tool. That's what we use it for. It's a great search tool as well. It took 5 days for ChatGPT to reach 1 million users. By comparison, Instagram took 2.5 months. Netflix, almost 3.5 years to get 1 million users. So the take-up on AI is undeniable. The next piece of news, interest rates. The Fed lowered back in September. Earlier this month, the Fed cut interest rates by 0.5 point, which was 25 basis points more than many expected. Usually in history, central banks, the U.S. Fed has a history of lowering interest rates by 25 basis points at a time or 0.25%. They lowered rates dramatically by half a point despite, the job market accelerating. So either they were catching up to something that they wanted to get to a point, or they are seeing something that we're not seeing at the moment. Either way, it was a bit of a surprise. And finally, inflation. So I've got 3 charts here in front of you. So let's see what we've got here. The first price that you're going to see down here is soy. So soy is an input that goes into our food. And you can see that the chart price down is 45% from this commodity peaking back in June of 2022. Here we have the oil price peaking around $120 a barrel back in June. And we're, as I said earlier, we're around this low 60s, high 60s, mid 70s price. And over here, what we have is wheat, another sort of consumer staple. So when you've got these sort of commodity prices coming off dramatically, and basically are not pre-COVID levels, it's fair to assume that inflation, in terms of the rise of the pace of the rise in prices, is certainly something that is behind us and will slow down if the input prices have come off. Now, it'll take some time, 3, 6, 9 months for these lower prices in the inputs to make their way into the marketplace. But inflation risks being behind us is certainly, I would say, a safe bet, according to the charts. Now, in the past, I've been criticized and talked about market breadth and basically focused performance, and only technology was carrying the markets, or only energy in Canada, and so on and so forth. So what I wanted to show you is exactly what a healthy market looks like. We can have this discussion whether how sustainable this performance is, but this is the different sectors in Canada and the different sectors in the US. And you can see that basically outside of telecom in Canada, everything's up substantially. And same thing in the US. So this is the performance for the past 190 days. So basically since the beginning of the year. It's the same time frame here in the US. Everything is up. And that is a healthy sign. Let's call it for what it is. Let's trade the chart in front of us. Let's recognize the chart in front of us. And really what we're talking about is there's a broad, investors have really taken on to a shine, if you will, to all sorts of investments across the public markets. Now, investors tend to look down 3, 6, and 9 months down the road. So clearly, investors at this juncture are thinking that there are better days ahead for the economy. As we look forward in time, what are we looking at? Well, let's start with the immutables. We are focused on dividends or share buybacks, ideally dividends for the portfolios that I'm responsible for, but share buybacks are also a great indicator of corporate health in terms of profits. Quality balance sheets, we don't want to see too much debt. If we do see companies taking on the debts in their balance sheet, we want to make sure it's for sort of accretive endeavors. Proven management, we want to see stability in management. We don't like to see a high rate of turnover. Global approach to their business, valuation discipline, so we don't want to pay too much for our stocks or our future profits. And we kind of ignore the headlines, really. We try to zone out from the noise. What are the adjustments we are making or thinking about making? Well, interest rates and inflation. We just talked about inflation's coming off, possibly coming off, I should say. Is it transitory? Is it permanent? There's all sorts of inflation. There's goods inflation, services inflation. What we do know is that we have to make adjustments as we move forward in terms of that expectation. Consumer spending, that's kind of a conundrum for us. There are some sectors of the economy where consumer spending is great, or at least decent, and other parts of the economy where consumer spending has really, really taken its toll, and thanks to higher inflation and higher housing costs. Now, as we look forward, those changes are not going to be as pronounced in the future. So these are the adjustments we're thinking about. Migration and construction. We obviously inflation, immigration, and housing all have an impact on the economy at the moment. They're a very large part of what's going on economically and politically. The K recovery, we're looking at demographics. In the developed world, we're having sort of a aging older demographic, its impact on consumer spending. and its impact on politics. And then the K recovery, as we mentioned before, there's a strata socioeconomically is doing very well, and there's another strata, a large component of people that are not doing as well. Finally, government policies and technology are all forcing us to rethink our strategy, not necessarily our strategies, but our implementation of our strategies. As always, thank you for watching. If you have any questions or comments, we're all ears. Your emails, I should say, are always welcome. Thank you and have a great day.